Lots of negative headlines recently as the analysts have been disappointed with the most recent economic data. What's all that mean for the apartment market, and which metros may be most vulnerable if the economy continues to slow down? Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons and I'm with Greg Willett, the VP of Research and Analysis at MPF Research. Greg, we've seen a slew of new data recently on the economy. None of it looks very good. What's all that mean? Paint the big picture for us.
Again, lots of numbers did come out recently. Pretty weak in all of them. For example, the revised GDP numbers are not great. Manufacturing activity has slowed down a little bit. Consumer sentiment is off once again. We're also certainly seeing things like the single-family home sales numbers going into the peak of the sales period were just really downright terrible. And then the most recent stat, job production for May, we want to see a number around 200,000 jobs a month to really help the apartment industry. It came in at well less than half that, so not a good story there. And I wouldn't really be worried about any of those numbers individually, but the fact that they all came together at once does suggest that the economy is very fragile at this point.
So Greg, does that mean we've all been a little too optimistic on the prospects for the apartment market?
Well, we are just talking about one set of data, and you can certainly get a blip in the overall picture. And it is important to realize that we are talking about slowing growth, not actual backtracking. We're still generating new households, and the apartment sector is capturing more than its historical fair share of total housing demand. So it's going to take a lot more than what we've seen thus far in the cycle to really get us off track in terms of forward progress on apartment occupancy and rent growth.
Okay, so not a big deal so far, but let me play the pessimist here. If things continue to slow down, which metros do you think could be most vulnerable to seeing some potential losses in the apartment sector?
Well, in that regard, I think we look at the metros that actually haven't really switched into job production yet. And so if we see the national picture slow down, we could see some big hits in some of these ones that are kind of struggling at this point. And as we look at the 64 markets across the country that we look at most closely, there are 17 at this point that are technically in annual job loss as of the latest metro level data release, which came in April. It's interesting, if you look at 5 of those, though, I think we can pretty much ignore those because everything actually looks fine. And we'll pull up a graphic here for you. Those markets are Albuquerque, Oakland, Baltimore, Colorado Springs, and Minneapolis, which supposedly are losing 500 to 6,300 jobs apiece during the course of the past year. But if you look at what's happening in the apartment market, they do have decent demand levels. Occupancy is pretty full and shows some momentum, and they're really near the top of the charts for annual rent growth across the nation. So it would be very surprising if, in fact, these markets were really backtracking in terms of their economic totals.
So 5 of the 17 are looking pretty good, so that leaves us with a dirty dozen.
It does leave us with another dozen markets, but I think you can actually break that group down into 2 segments there. Let's pull up another list for you. There's a group that includes Richmond, Memphis, Indianapolis, Birmingham, the Fort Myers, Naples area in Florida, Las Vegas, Virginia Beach, Norfolk, Kansas City, and Baton Rouge. And in those markets, what we see on the job front as of April is minus 700 jobs to minus 5,800 jobs. If you dig down into apartment market data, you do see that, in fact, those are markets where there's clearly some economic weakness. Demand is not great. Occupancy rates are mediocre to bad in those areas, not necessarily showing a whole lot of momentum. Rent growth kind of goes all over the place within that group, but the ones that are doing the best seem to be ones that maybe they're overreaching a little bit, and it wouldn't be surprising to see the pricing plateau or even backtrack a slight bit in those markets.
Okay, so by my count, we have 3 left. Does that mean we have 3 that are pretty much toast?
Well, you really are playing the pessimist role today, and I don't know that I would characterize it quite that strongly, but these are three markets where I think the bottom line, the economy as it is right now, is just messed up in these, and further backtracking for the U.S. would certainly be bad news. So here's the list of the markets you don't want to be on this list. And we would start that with the Inland Empire, which has lost 16,400 jobs in the year ending April. Next is Sacramento, which lost 14,600 jobs during the past year, and Atlanta, which downsized by 9,000 positions. Now, these are markets where demand is fairly weak. The occupancy rates certainly are not great in any of these, and the rent growth numbers pretty mediocre in two of the three. The exception would be Sacramento, and frankly, it's hard to understand exactly how Sacramento has any rent growth momentum going at this point. It'd be right at the top of my list for a market that would be vulnerable to seeing some backtracking in pricing.
So there you have it. And let's look at the glass half full picture here. And it's important to put some context into this discussion because we are looking at markets with downside risk, not the baseline forecast for the U.S. And we are certainly continuing to forecast solid revenue growth for the U.S. apartment market as a whole in 2011. And we have not yet seen any indicators in this economic data to suggest that that forecast should be downgraded. So with that, let's wrap it up. For Greg Willett and for MPF Research, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.